Palantir stock has doubled in the last year, and year to date is up a whopping 84%. That's more than 5 times the S&P 500. Is Palantir Technologies a game changer or a ticking time bomb? With massive government contracts and a push into AI, this controversial tech stock has investors divided. Should you jump on board or stay clear? Stay tuned as we break down Palantir's secrets, latest moves, and what it all means for your portfolio. Let's dive right in. All right, 4 points that we are going to cover in this video. Number 1, company background / business model. The business can very simply be explained as data mining for its clients. So we're talking about taking big data and creating actionable information from it. Some of their customers include the CIA, FBI, and the NSA. Part 2, company update. So Palantir reported its 2Q24 results, and there are many noteworthy improvements that I can't wait to tell you all about. Part 3, the opportunity, positives and negatives. The stock has experienced tremendous volatility, but the business really turned the corner in 2023, and it's continued through 2Q 2024. And part 4, valuation. On Wall Street, we build 3-statement financial models culminating in a discounted cash flow or DCF valuation. I've built a 3-statement model for Palantir with a DCF, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Okay, part 1, company background / business model. The company was founded in 2003 by Peter Thiel, Alex Karp, who's the current CEO, Joe Lonsdale, Stephen Cohen, and Nathan Gettings. The headquarters are in Denver, Colorado. The company mission: we build software that empowers organizations to effectively integrate their data, decisions, and operations at scale. Notable clients include the U.S. government, so CIA, FBI, and Department of Defense, as well as multinational corporations like BP and Airbus, and NGOs or non-government organizations. The business model. All right, so this business started out focused on government, and it's slowly transitioned into commercial. As of right now, 55% of revenues are from government contracts. These are long-term contracts from U.S. government agencies and allied nations. These contracts are often multi-year and high value. Now, while governments tend to have a seemingly infinite budget, regime changes and elections can leave the tail end of some longer-term contracts having less certainty. 45% of revenues are in the commercial sector. These are private businesses. So there's an increasing focus on expanding into commercial sectors, offering data analytics solutions to private enterprises in various industries like healthcare, energy, and finance. All right, so how do they make money? There's 3 ways that they accomplish this. They have a subscription-based model, which offers software as a service for its platforms, generating recurring revenue. They also have usage-based revenue, so some clients are charged based on the extent of the software that they use, which varies with the depth of data analysis and application. They also have strategic partnerships, so they collaborate with large organizations and other tech companies to develop and implement its software, which enhances customer adoption and scalability. So Palantir has 4 principal software platforms: Gotham, Foundry, Apollo, and its AIP, or artificial intelligence platform. So Gotham is a software platform which enables users to identify patterns hidden deep within data sets. Foundry creates a central operating system for a company's data. It allows individual users to integrate and analyze the data that they need in one place. Apollo enables customers to deploy their software virtually in any environment. It's a continuous delivery and infrastructure management platform. And lastly, the AIP, or artificial intelligence platform. This includes large language models that can transform structured and unstructured data into LLM understandable objects and can turn organizations' actions and processes into tools. So AIP begins with a boot camp to showcase what the software can do. That's followed up typically by a pilot, which then within weeks can turn into a multi-year contract. Since launching AIP in mid-2023, Palantir has completed over 1,025 boot camps in organizations in the United States and around the world. So 5 examples where Palantir has moved from prototype to production include Fujitsu. By creating alert systems, demand forecasting, inventory control systems, and so on, this transformation resulted in an impressive annual cost reduction of $9 million within just 3 months. Insane. Panasonic Energy, empowering maintenance technicians to diagnose and fix equipment problems faster, increasing line uptime, decreasing rejects, and ensuring more efficient production of billions of EV car batteries each year. Tampa General Hospital. So they partnered with Palantir on AI software to improve bed placement, patient scheduling, staffing allocation, and more. And quote, "We've reduced patient length of stay by 30%. We've also saved hundreds of additional lives through this work." incredible. Starlab will leverage Palantir Foundry and AIP in its commercial space station to drive value in its in-house payload management system for international space station customers. And then lastly, Polaris. Palantir's AIP empowers Polaris to combat human trafficking with real-time data analysis and AI-powered insights. So, what is the takeaway here? Palantir tackles situations where a company may not have a complete data set. This is the crucial difference. Other platforms require complete data. All right, part two, company update. So the 2Q 2024 results, total revenue increased 27% year over year to $678 million. Now that was broken into two pieces, government and commercial. Government revenue increased 23% year over year to $371 million, reflecting continued strong performance in government contracts. U.S. government contract revenue increased 24% year over year to $278 million, driven by momentum in Department of Defense and favorable deal timing. Now, in 2Q 2024, Palantir signed a new 5-year, $480 million contract with the Chief Digital and Artificial Intelligence Office to scale AI and machine learning capabilities across the U.S. Department of Defense. Incredible. Now, the other piece is commercial revenue, which grew by 33% year over year to $307 million, with U.S. commercial revenue up 55% to $159 million. Now, this is important as the company continues to focus on increasing its exposure towards commercial rather than government customers. U.S. commercial customer count grew 83% year over year to a total of 295, and 3-year U.S. commercial customer count has grown 9x. Now, in terms of deals, 123 U.S. commercial deals closed, which is a 98% year-over-year increase. 96 of the deals were at least $1 million, 33 were at least $5 million, and 27 were at least $10 million. GAAP operating income of $105 million with 16% margin. This was up 14% year over year. That's a massive expansion in margin. Now, Palantir achieved GAAP operating profitability for the 6th consecutive quarter, so they're showing this positive momentum. In terms of earnings, they achieved GAAP net income of $134 million with 20% margin. Now, GAAP EPS grew 500% year over year to 6 cents per share from 1 cent per share a year ago. Palantir achieved GAAP profitability for the 7th consecutive quarter. Again, that positive momentum. Now, here's another interesting fact. Palantir ended Q2 2024 with $4 billion in cash and cash equivalents and no debt. Let me say that again, no debt. Now, this is really awesome. They raised their full year revenue guidance. They increased their outlook from 2.25 to 2.75 billion. That's a 22% increase only halfway into the year, with expectations for continued profitability and cash flow positivity. So what's the takeaway? Another solid quarter with all metrics moving in the right direction and a nice increase in the full year 2024 guidance. All right, part three, the opportunity, positives and negatives. So I don't like bad news. Let's get it out of the way. Bad news first, negatives. So high valuation concerns. The stock trades at a high valuation relative to its earnings and every other metric, which could lead to volatility and downside risk, especially if growth slows. So if they miss their projections or estimates, you're going to see a crash in the stock. Now, they have a high current multiple of 26 times revenues, not earnings, revenues. And that assumes continued high growth. A bad quarter or softness could have a significant negative impact on the stock. Now, remember, the stock has been as high as 35 and as low as 6 over the last 4 years. So it's proven to be an incredibly volatile stock, which is a hard sell for most investors. Customer concentration. They have a heavy reliance on a few large government contracts, and that poses a risk if there's any reduction in government spending or contract renewals. Now, while no customer represented more than 10% of revenues, one customer represented 15% of accounts receivable at year-end 2023 and 32% of accounts receivable as of June 30th. This is a little bit of a red flag because accounts receivable are revenues that have been booked, but they haven't been earned yet. So if this continues to grow, it can become a significant exposure. Slow commercial adoption globally. Now, while U.S. commercial growth is strong, global commercial adoption has been a bit slower than anticipated. This is very much a show-me business where once you get results, there will be high retention and high switching costs, but it's hard to get that initial business. You can't quantify the potential value or savings until the software is deployed. So contract sizes tend to start out small and build over time, making revenue more sustainable, but spreading it out over time. Geopolitical risks. Exposure to international markets and reliance on government contracts could be affected by geopolitical tensions or regulatory changes. High operating costs. Research and development, sales and marketing expenses are relatively high and negatively impact margins. Now, the company needs to manage these costs carefully to maintain profitability. This is part of their business where upfront costs are high before being able to secure a lucrative long-term contract. Dilution risk. Frequent stock based compensation and potential future capital raises could dilute existing shareholders' value. Now, while the company has not issued equity to finance the business since 2020, it has issued equity via stock based compensation to the tune of $3.3 billion over the last 5 years, and $476 million of that last year alone. Something to keep an eye on. All right, let's hit up the positives. Strong government contracts. So those provide a stable and substantial revenue source, which are long-term and a foundation for growth and financial stability. Why? Because there's less revenue volatility. Commercial sector expansion. So we talked about this earlier. Strong growth trajectory in the commercial sector, especially in the US, diversifies the revenue beyond the government reliance. Profitability and cash flow. So achieving profitability in 2023 and generating significant free cash flow strengthens the balance sheet and enables reinvestment in growth areas. Innovative technologies. A strong focus on AI and machine learning positions Palantir as a leader in advanced data analytics and operational intelligence software. As mentioned earlier, since launching AIP, or their artificial intelligence platform, in mid-2023, Palantir has completed 1,025 boot camps in organizations in the United States and around the world. Strategic investments and partnerships and product innovations could lead to enhanced adoption and market penetration. Market positioning. Palantir's unique blend of government and commercial capabilities makes it a hybrid player with a competitive edge in both sectors. Part 4, the moment we've all been waiting for, the valuation. So we're going to start with the balance sheet. The company has $4 billion of cash at the end of 2Q24, and there's been a 4-year increase in cash and cash equivalents of 3.2x. Now, accounts receivable has increased 7.2x over the last 4 years. This is a potential red flag, but it's the nature of the business. Remember this when we look at the income statement next. Now, days sales outstanding, which is how long it takes for them to actually collect the receivables, has increased 4x from 2019 to 2023, going from 12.4 days to 51.1 days. We need to see this reined in by Palantir. They need to do a better job of collecting their receivables. Now, we don't see a big increase in PP&E because the product is essentially SaaS, or software as a service. So there's no real need for physical assets, which is a massive advantage. Debt is zero, and the company has been net cash for the last 4 years. This gives them tremendous optionality. So what's the takeaway? They're very conservatively financed, net cash, meaning cash is greater than debt. They have a solid balance sheet, no debt, and there's no real balance sheet red flags. Let's hop in the model. Right, balance sheet. As we mentioned, we've seen a 4-year growth in cash at 3.2x. You can see that nice trajectory here. The bulk of the cash they're taking and they're putting in marketable securities. So these are super liquid, like US Treasuries. Also, we mentioned accounts receivable increasing, but something to keep an eye on. We want to make sure that they're collecting the receivables, because it's one thing to sign a big contract. It's another thing to actually collect the money. Debt, fortunately, has been zero. And we overall see a very nice, clean balance sheet for the company. All right, next we have the income statement. So revenue has increased 3.7x in the last 5 years. This is a very high margin business with gross margin around 80%. Now, from 2018 to 2023, gross margin increased from 72% to 81%. This is indicative of operating efficiency and shows that they can pass their increasing costs on to their customers. EBITDA and net income both became positive for the first time in 2023. We're going to see this impact on the cash flow statement next. The company has interest expense, but no debt. How is that possible? Well, the company has a $500 million credit facility, and there's a cost to maintain that of 0.75% or 75 basis points. So what's the takeaway? Everything is headed in the right direction, and there's huge positives, but it makes the company difficult to value with a limited track record and no pure play comps. Let's hop in the model. All right, income statement. We see a massive increase in revenue, 3.7x, super high growth, super positive right here. EBITDA turned positive in 2023, as well as net income. This is a massive development for the company and for investors. All right, next we have the cash flow statement. Free cash flow has more than doubled in the last 2 years, driven primarily by net income. This is going to have a positive impact on our DCF valuation. Now, following the lead of the Mag 7 tech stocks like Apple and Microsoft, they've invested cash wisely in marketable securities like US Treasuries. Cash is projected to almost 6x by the end of the model. So what's the takeaway? Positive trajectory with large potential upside. Let's hop in the model. All right, cash flow statement. As we can see here, Free cash flow turned positive in 2021 and has doubled since then. Truly remarkable. As we mentioned, CapEx, really not that high. Remember, this is software as a service, so it's not a capital intensive business. We see net cash from operations or operating cash flow has increased substantially, mostly driven by that transition from negative to positive net income. Also, a couple other things to note here. No debt issuance, no equity issuance. This is awesome, which means that they're finally self-sustaining or self-funding. Now, the other thing I want you to notice here, I mentioned the Mag 7, Apple, and Microsoft. What they do is with their huge cash balances, they invest it in marketable securities. So you could see that Palantir has done that over here, over $6 billion invested in marketable securities over the course of the last 3 years, and that has generated for them almost $3 billion of cash. Last but not least, what I want to show you is the fact that cash is projected to increase 5.8x by the end of our model. Absolutely incredible. Okay, forecast drivers and DCF assumptions. So long-term top-line revenue growth is in the low 20%. They have incredibly high gross margin, over 80%. They have a super high beta. Now, this is why the valuation has been volatile. If you actually look at multiple sources, they show a beta of close to 3. 2.7 in most cases. So what I did was I used a software industry average of 1.5 because the company should become less volatile as it continues to mature. Now, remember, there's no leverage. So there is option value to take on debt to lower the weighted average cost of capital. Remember, cost of equity is higher than the cost of debt because equity is riskier than debt. So what this means is that if the company does take on some debt, the cost of that debt is less than equity, which will reduce their discount rate or their weighted average cost of capital. That will ultimately increase valuation. So what's the takeaway? Conservative assumptions are going to equal conservative results. Let's hop in the model. Okay, so forecasted line items, I mentioned that we are in the low 20s. We're at 22%, and that's based on the company guidance. We're actually slightly below Wall Street, which has a consensus of 22.4% top line growth. A few other things to note here. COGS has decreased substantially. We talked about this earlier. That expansion that we've seen in their gross margin, really tremendous, that they've controlled their cost accordingly and passed them on to customers. In terms of DCF assumptions, a few things to note here. They don't have any debt, so they don't have a rating. They have no leverage. So these are positives in the grand scheme of things, but they can reduce their weighted average cost of capital if they add debt, as we mentioned. Now, something else to note, a lot of cash. This is awesome. Almost $4 billion of cash. But the last thing that I want to note, which is very important, the terminal value. The terminal value drives the bulk of the valuation. If we look here, I chose 15 times. Now, this is higher than what I chose last time in our valuation 3 months ago, but I want to explain this here. So the current TEV to revenue for the comps is 11.5. The current Palantir multiple is 26. So we'd be hard pressed to use 26. So let's dig in and see what's going on here. So the mean of the comps is 11.5. They kind of range from 10 to 15. Now, over the last 16 quarters, Palantir's average range was 7.5 to 45. The midpoint is 26.3. So the average is 20.7. So that means 20 would be something you could logically justify for Palantir. But since the comps are 10 to 15, I'm assuming that there's going to be a reversion to that high end of the comps of 15. So I place Palantir at the higher end of that range at 15x. All right, DCF valuation, the moment we've all been waiting for. We ran 3 scenarios, bear, base, and bull with the current model at base. Future cash flows are discounted back to today to get to TEV. We strip out net debt to get to equity value. The company has about $2 billion of NOLs or net operating losses that give almost $1 to the ultimate value. Basically what I did was they have $5 billion that are booked, and then I actually shielded their taxable income on a going forward basis, and that created about $2 billion worth of value. So I just wanted to mention that because you're going to see that in the DCF. The company is high growth, has lots of cash and upside potential, but is it worth buying today? Remember, the stock is up 84% year to date, which is 5x the S&P 500 return. Wall Street has Palantir at an average of 25.30, which is a 20% premium, and a median of 28, which is a 9% premium. So what does our analysis show? Let's hop in the model. DCF time. So EBITDA less DNA gives us EBIT, less cash taxes, EBIT or NOPAT. We add back the DNA. We take into account changes in operating working capital. We strip out the CapEx. We get free cash flows to the firm. Terminal value, remember, 15 times the terminal revenue. We get our cash flows to discount. We multiply them by the discount factor, basically time value of money, create the today values, which are right here. We add those together to get TEV. We strip out the debt. We add the cash. We strip out the non-controlling interest. We add the associated investments. I'm also adding the tax loss carry forward or the tax shield of over $2 billion here. We get an intrinsic equity value of 64 almost $65 billion. We divide by the shares outstanding, we get an implied share price of 29 bucks versus the current share price of $30.51. That's a slight premium of 4.9%, which is a sell. All right, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth and CapEx intensity, as well as WACC versus the terminal multiple. Now, what were the results? 37 out of 50, or 74%, showed a sell rating. 13 out of 50, or 26%, showed a hold rating. And 0 out of 50, or 0%, showed a buy rating. We ran each of the three scenarios equally weighted. We got a weighted average value of 2907, which is a 4% premium. And our model from 3 months ago had a weighted average value of 2222. So our valuation has actually increased 31%. This is because expenses have decreased 2.5%, with revenues increasing slightly as well. So what's the takeaway? Utilizing conservative assumptions, we show a sell rating for the stock at a slight premium. Let's hop in the model. As you can see here in the sensitivity analysis, looks like a ketchup and mustard fight, no green to speak of. Ultimately, the stock has gotten a little ahead of itself. Majority sell, but some areas where we have a hold. And then we come down here to the scenario analysis. So looking at the scenario analysis, we equally weight each of the three scenarios. In the bear case, we get almost 27. Base, which is the current case, 29, and the bull case, which is pretty much right around fair value, a little bit above, about $1 above the current share price. So we end up getting 2907, which is a slight premium of 4.7%, which ultimately results in a sell rating. We don't want to overpay for a stock. Okay, the wrap up. So Wall Street has Palantir at an average of $25 with a high of 38, which is a 25% discount, and a low of $9, which is a 239% premium. So a huge gap there. The stock has shown massive volatility, going from an all-time high of over 35 within 4 months of its debut to losing more than 80% of its value over the next 2 years to close just above $6 about 21 months ago. Now, you should seek the advice of an investment professional always. I do not know your personal financial situation, and this content is meant to educate. Now, I must tell you that I do not have a position in Palantir, but if it pulled back to the mid-20s, I would be very interested in potentially including it. Now, in fact, 1 month ago, the stock pulled back to $24. Don't be discouraged. Keep an eye on it because you can use volatility to your advantage to enter into the stock. This is a very unique company with a dominant position in a highly niche space that will only grow over time. Extracting actionable information from big data will continue to become more valuable as time goes on, and I can't wait to see how Palantir transforms the tech industry. Now, if you like this and would like to see another tech valuation, you could check out my Tesla model here or my Microsoft model, which you can find here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.